What if you could get a refund of your term insurance premiums? Here is a question most people never think to ask. What if the premiums you paid for your term insurance came back to you while the protection stayed active all along? That is not hypothetical. There are actually two types of term plans in India built around exactly this idea. One is called Return of Premium Term Plan or TROP. The other is called a Zero Cost Term Plan. They work differently and they suit different people. In this video, we are going to break down how each of them works, what you actually get back, and how to figure out which one, if any, makes sense for your situation. But to understand why these plans exist at all, we first need to talk about something most term insurance buyers have felt at some point, usually around renewal time. Let's get started. If you have ever hesitated before buying a term insurance plan, there is a good chance that this thought crossed your mind. You pay a premium every month for 30 years. Nothing happens to you, you survive. And at the end, you get nothing back. That feeling is not irrational. When you pay for a car insurance policy and do not make a claim, you accept it because the policy period is 1 year. But paying for 30 years and walking away with zero at the end feels different. It feels like a loss. This is a question we hear all the time, and it is completely fair one. If you have been paying premiums for years and nothing has happened, it is natural to wonder whether there is a version of this that gives something back. That is exactly why return of premium and zero cost term plans exist. The important thing to understand before we go further is this. A regular term plan is not a bad product. It is a pure protection product. You pay for the years your family needs a financial safety net. The premium is low because the insurer is only covering risk, not building a savings component on top of it. If you survive, you have paid for protection you thankfully never needed to use. That is the deal. And honestly, for a lot of people, that is perfectly fine. But if the idea of paying for 30 years and getting nothing back does not sit right with you, you are not alone. And these two products have been built exactly for that feeling. Let us look at both. A term plan with return of premium, also called a TROP, is a type of term insurance plan that gives the policyholder back the total premiums paid if they survive the policy term. This is the feature that sets it apart from a regular term plan, where no survival benefit exists. Every other aspect of the plan works the same way. If you pass away during the policy term, your nominee receives the full sum assured as a death benefit, exactly as they would with a regular term plan. The death benefit is not reduced or altered in any way by the return of premium feature. The difference only matters if you survive. Let us take a simple example. You buy a TROP plan with a sum assured of 1 crore rupees. You pay a premium of rupees 3,000 per month for 20 years. Over the full term, the total premium outgo comes to rupees 7,20,000 when the policy matures and you are alive. The insurer returns that 7,20,000 to you in full. Now, an important detail that most videos on this topic skip: what exactly gets returned and what does not. What is typically returned to you at maturity? The base plan premiums you paid throughout the policy term. Modal loading premiums if you paid on a monthly or quarterly frequency instead of annually. And in most cases, any additional underwriting premiums charged by the insurer based on your health or habits. What is not returned? Taxes charged on your premiums and rider premiums in most cases. If you added an accidental death benefit rider or a critical illness rider to your TROP plan, those additional premiums are generally not refunded. Some insurers may refund rider premiums, but this is the exception and not the rule. Always check the policy brochure before purchasing. One more thing worth knowing: the return of premium option can only be selected at the time of buying the policy. You cannot add it later. If you already have a regular term plan and want to switch, that is not possible either. A new policy would need to be taken. A zero-cost term plan is not the same as a TROP. The two are often used interchangeably in conversations about term insurance, but they work through completely different mechanisms. In a TROP, you stay invested in the policy for its full term, and you receive your premiums back only at maturity. In a zero-cost term plan, you have the option to exit the policy at a specific point during the term, before it matures, and receives the refund of the premiums paid up to that point. This exit option is backed by IRDAI provision that allows certain term plans to offer a structured early exit with a premium refund. The key here is that the premium for a zero-cost term plan is the same as a regular term plan. You're not paying extra for the refund option. If you exit, you get your money back. If you continue through the end of the term, your cover runs normally. And the term zero cost comes from the idea that if you exit and get your premiums back, you have had protection all those years and still got your money back at the end. The exit window and the exact percentage refunded vary by plan and insurer. So, reading the policy brochure carefully is essential. Here is the question that actually matters. If TROP gives you your money back, why would anyone choose a regular term plan? The answer comes down to one thing: what you pay every month. A regular term plan has the lowest premium of all the three. You are paying purely for protection, no savings component, no refund obligation. The insurer covers your risk and nothing else, which is why the premium stays low. A TROP plan costs more for the same sum assured. How much more depends on your age, your policy term, and the insurer. But the gap is meaningful. The reason is simple. The insurer knows they will have to return your premiums if you survive. That obligation has a cost, and that cost gets added to your premium. What you get back at the end is the total of what you paid, not a rupee more. No interest, no growth, just the nominal value of your premiums returned. A zero-cost term plan sits in a different place entirely. The premium is the same as a regular term plan, so you are not paying extra, but at a specific point during the policy, you have the option to exit and get your premiums back. If you do not exit, your cover continues as normal. So, in a best-case scenario, you get the protection for the years you needed it and walk away with your money if your circumstances change. So, how do you choose between these three? If keeping your monthly outgo as low as possible is the priority, a regular term plan is the right call. You get the highest cover for the lowest cost and your family is fully protected. If the idea of paying for decades and walking away with nothing does not sit right with you, and you are willing to pay a higher premium for the certainty of getting that money back, TROP is worth a serious look. Just go in knowing that the refund carries no growth. It is your money returned, not your money grown. And if you want the flexibility to exit the policy at a future point without losing what you have paid, the zero-cost term plan gives you that option without charging you extra for it. There is no universally right answer here. It comes down to what matters more to you: the lowest monthly cost, the certainty of a refund, or the flexibility to exit. Once you know which of those three things you are optimizing for, the right product becomes fairly obvious. Here is the comparison in one place. Screenshot this or note it down. Take a screenshot of this table. This is the clearest way to explain TROP and zero cost plans to anyone in your family who is still on the fence about which one to buy. None of these three options are universally better than the others. They serve different financial temperaments and different life situations. The most important thing is that you choose one and buy it now rather than waiting for the perfect option. If you want to explore which ABSLI term plans, including the return of premium option, all relevant plan links are in the description below. Each plan page walks you through the available variants so you can find one that fits your situation. Before we wrap up, here are the most common questions we got on this topic. Let us get straight to them. What is a return of premium term plan and how is it different from a regular term plan? A return of premium plan works exactly like regular term plan. If something were to happen to you during the policy term, your nominee receives the full sum assured. The difference is what happens if you survive to the end of the term. With a regular term plan, the policy simply closes. With a return of premium plan, all the base premiums you paid come back to you. The premium for a TROP is slightly higher than the regular term plan for the same cover. And that is the trade-off to weigh. You pay a little more every month in exchange for getting that money back at the end. Is a return of premium term plan worth buying? It depends on what matters to you. If the idea of getting your premiums back at the end of the term gives you peace of mind and fits your monthly budget comfortably, a return of premium plan is perfectly sound choice. If you are comfortable with a lower monthly premium and do not need the refund, a regular term plan gives you the same core protection at a lower cost. Either way, the most important thing is that your family is covered. The right plan is the one you will actually stay committed to for the full policy term. If this video helped you understand TROP and zero cost term plans more clearly, please share it with someone you know who has been asking this question. Hit the like button and subscribe so you do not miss the next video in the series. All relevant links are in the description below.